Welcome to the Monocle Banking Podcast, a series brought to you by Monocle Solutions, where we balance the books in the dynamic world of banking. I'm your host, Michael Avery, and in this series, we're going to be exploring the evolving landscape of banking here at home and around the world. We're going to trace the roots of fractional reserve banking. We're going to talk about the rise of the all-powerful central bankers, the booms and the busts, from bank loans to bank runs, from old-school vaults to virtual wallets, and the ever-increasing rise of bank regulation and its impact on local South African financial institutions. So whether you're a banking professional, if you're just a financial enthusiast, or someone who simply wants to stay informed about the world of finance, you're certainly in the right place. Well, welcome to this fourth episode of the Monocle Banking Podcast. It's really been a busy week in the banking world. We saw the Banking Association, BASA of South Africa, and the SA Banking Risk Information Centre, SABRIC, announcing a collaboration with the Hawks to open a forensic analysis centre to boost our capacity to investigate and prosecute financial crimes. All of this really in response to our FATF grey listing. And we also saw this week state-owned Itala Bank has fallen foul of the regulators for failing to safeguard its clients' insurance premiums, putting its decades-long quest to obtain a permanent banking license in question. The Durban-based bank is also under fire from the Financial Services Conduct Authority, the FSCA, for failing to submit financial reports for 2 years. And we also saw Standard Bank admitting to being at fault for labelling two proof-of-payment documents that the economic freedom fighters had sent to AfriForum as fraudulent. AfriForum last week issued a statement accusing the EFF of falsifying the bank's proof of payment, and AfriForum received an electronic proof of payment to the value of 316,000 Rand from the Red Berets, which they had to pay for legal costs to it. But it turns out the bank's business unit has for the past 8 years been using an outdated letterhead, which included the names of directors who'd resigned long ago, as well as an outdated company logo. Can you imagine that? Well, it's a pleasure to welcome back Professor Brian Kantor, an economist, former chief investment strategist of Investec Wealth and Investment, and Professor Emeritus at the University of Cape Town. Brian, great to have you back on the show. And really, last week we left off about talking about how the Reserve Bank has managed its inflation targeting mandate, and I had some really good feedback from that. But I want to focus a little bit more on this issue of trust in banking, and it's maybe slightly a more philosophical question, and then we'll get into some regulatory questions. But in light of Standard Bank's blunder, we've got financial intermediaries and banks as very important actors in managing the payment system of an economy. Could you just firstly explain their role in facilitating transactions and how they contribute to economic stability?
Well, you could hardly imagine a modern economy without money. And money is overwhelmingly in the form of deposits at a bank, which are perhaps best described as transmission accounts. So all the exchanges of money for goods and services are facilitated by a bank. And transfers are made digitally these days. Very low-cost transfers are made through a digital process which the banks provide. So the payment system, which clearly facilitates economic specialization, economies of scale and all that, the alternative would be barter. If you didn't have money, you'd have to barter, which is, of course, inconceivable. So you have money and you have a payment system managed by the banks, which is crucial to the economy. It's a crucial service. It's an indispensable service. And the reason why we should be concerned with the stability of the banking system is because the banks supervise the payments. And without that, you'd have chaos. So the reason for, if you like, for coming to the rescue of a banking system which is melting down is to preserve not so much the banks or the shareholders in those banks, but the payments system. And we certainly depend upon the reliability and predictability and efficiency of the payments system, which I think, again, you could argue or you could realize because it's more digital, has become a lower operation. In the old days, banks used to have to clear checks. These days, they clear digitally. It must be a whole lot less expensive than it was, though one of the expenses is clearly avoiding fraud. So the banks are responsible for the safety of the deposit accounts, the transmission accounts that people hold conveniently with them.
And I think that's an important point you raise, because what we're seeing currently, Brian, is this fierce competition amongst not only financial service providers, but would-be financial service providers. We see telcos who are now using the very same rails and banking system to offer payment services and systems. We see over-the-top providers. We see alternative payment mechanisms like cryptocurrencies emerging. All of this points to fierce competition with the banks for funds and investments, and it's very interesting. How might emerging alternatives to traditional banking services impact the industry, especially in the context of providing payment services?
Yes, well, Bitcoin, I think, it doesn't involve banks. But if you're an alternative payments facilitator for a fee, you are, in fact, dependent on the banks also, because you can't provide that service without a banking account. So, yes, you're competing with the banks for the transfers that people want to make, but you have to have a deposit with a bank. These alternative payments providers also need a bank. And unless they are banks themselves, unless they have a license to operate as a bank when they become a bank. But if they don't have that license, and that's crucial here, I think, they depend on the bank. So the banks, in fact, the banking account is necessary to the purpose. So they have to keep their cash reserves with a licensed bank. And that raises all sorts of interesting questions about how do you qualify as a licensed bank with, and that's the essential distinction. If you're a licensed bank, you have a deposit account. The bank has a deposit account with the central bank. So that's what makes you a bank. You keep your cash reserves with the central bank. All other financial organizations, institutions keep their cash reserves with a private bank, with one of those banks that have the cash reserve, the deposit facility, the central bank, upon which they now typically earn interest. So, in fact, those deposits are no longer non-interest bearing. They are, in fact, interest bearing and quite attractive in that sense for that reason. More attractive than they used to be when they didn't pay interest. But the banks in South Africa and in the US and elsewhere now typically hold cash reserves, that is, deposits with the central bank in excess of what are regulated minimum cash reserves. So they hold excess cash reserves and they earn interest on their cash reserves.
So that is effectively, to an extent, sterilizing that capital that could be deployed elsewhere in the economy because they're attracting interest, and the banks clearly feel that it's attractive enough to do so. What do you see as the long-term impact of this move by the Reserve Bank to start paying interest on these cash reserves that private banks are paid by depositing their cash at the central bank?
Well, I think that's a big question. And one doesn't know how it will evolve. It's been true in the US since the global financial crisis that the banks have held truly mammoth amounts of excess cash reserves upon which they've earned interest. And the danger, if you like, is that those cash reserves can be turned into overdrafts. So a bank is in the business of making loans and overdrafts and holding, interest-bearing securities of all kinds as an alternative to holding cash. So if you turn cash into loans, the spending that that the banks facilitate with their loans then ends up as deposits in the banking system. So the loans made by the banks stay in the banking system. The overdrafts of one bank, or maybe even of the same bank, become deposits in other banks, and deposits of money. And that's, again, supply of money is a multiple of the fractional cash reserves that banks hold. Remember, banks keep a certain minimum, regulated minimum, now above the regulated minimum, of cash to meet the convertibility requirements of their customers, and they have to be able to exchange, meet the demands that other banks might be making on them for cash in settlement of the transactions of their customers. So if you have a general move, let's say we have a wave of optimism in the economy, and customers of banks, borrowing customers of banks, want more bank credit, they want to expand their businesses, they want to spend more, and they call for more loans from the banking system. If the banks have excess cash reserves, they can easily meet those demands, and cash then turned into another asset called an overdraft. That will lead to more spending and more deposits in the system. So that's something, and maybe because there's more money around, more spending, that may represent an inflationary danger to the system. So a central bank has to be able to control, if it wants to control the supply of money, has to be able to predict the demand for cash reserves by the banking system. And in order to predict, again, what will be happening to the supply of bank credit and the supply of deposits. Remember, the bank liability is their deposits. The assets, among others, are their overdrafts. They're two sides of a balance sheet that balances. So the momentum could easily come from the demand for credit from the banks, leading to an increase in the supply of credit, and as the spending is undertaken, an increase in the supply of money, deposits, that may well increase more rapidly than than economic agents wish to hold that money. And so the money then spills over into the markets for goods and services and other assets. And
driving up prices.
So if you want to control inflation, so this is not something given much emphasis by central banks. If you want to control inflation, you have to be able to control the supply of money. And the one in that control is the cash made available to the system by the central bank. And in days of yore, the supply of cash reserves was always very close to the regulated minimum. But now we have cash reserves, banks holding cash reserves well in excess of that minimum, presumably giving them a freedom to respond to demands for credit. That wasn't as easy as it was before. When banks, if they wanted to lend more, might have to borrow more from the central bank. So bank used to be, and in South Africa, used to be consistent borrowers of cash from the Reserve Bank. They're talking about 40, 50 billion rands worth of loans that the Reserve Bank would make to the banking system. Now that's not the case. Those borrowed reserves have fallen away, and the banks are holding excess cash. They're not unhappy with this, and they're earning interest close to the money market on those cash reserves.
But if the banks were to deploy that cash quickly, it could present an inflationary spike.
Yes, we could get some very pro-cyclical money supply and bank credit developments. That's always been true to a degree, that money supply and bank credit supplies tend to lead the business cycle in both directions. And central banks haven't always done a very good job of moderating the business cycle with their monetary policy. I think ideally remove the punch bowl when in fact people are wanting to drink more and stimulate. But they're reluctant. And at the moment, in South Africa, certainly, and in the US, there's certainly a reluctance to borrow from banks as well as a reluctance of the banks to lend. So private credit in South Africa, the supply of credit to the private sector is growing very slowly, less than 5% a year. Bank credit in general is growing a bit faster because the banks are lending more, understandably in the circumstances, lending more to the government. So the government has become a more important borrower from the South African banking system. In the US, the supply of bank credit has grown, and money supply has grown to a halt. So one of the reasons we think that the American economy is heading for tougher times. It's hard to think of an economy growing without growth. In the money supply and bank credit. The money supply, again, being the liabilities of the banks, their deposit liability. Cash is one of their assets. Overdrafts are another. One of the liabilities of a bank are their deposits. And the other liability would be their capital and reserves, which you at best would be of the order of, I say at best, it's also a regulated requirement these days of the order of 15% of the assets would be covered by shareholders' equity. So they can take a 15% loss, if you like, on the lending. That's all. If their lending losses exceeded 15% of their assets, they'd be out of capital.
And then making a path to the regulator, no doubt, which would potentially lead to a loss of trust in the institution and potentially bank runs and rinse, wash, repeat. We've seen it before. Which brings me back to my opening statement, and very broadly, and I'm not saying, Standard Bank has done any of that, but it points to potentially eroding trust. It's disturbing when you see a bank like Standard Bank committing such a blunder, saying that its proof of payment receipts have outdated directors that haven't been with the company for years and years. What does this blunder by the bank say about South Africa's banking system? And how important is trust in this system when we talk about things like moral hazard and bank runs? And, we've seen it in the past with the A2 banking crisis. How significant is trust in this fractional reserve system of ours?
Well, like in all business, reputation is essential to the purpose. A bank that cannot be trusted to pay back its depositors, to convert deposits into cash, certainly wouldn't attract deposits in the first instance. The banks have every interest in maintaining the trust of their depositors. They are highly leveraged. Remember, a bank is a highly leveraged business. If you think of leverage as the amount of debt you have relative to your own capital. Now, banks are highly leveraged. They have very little capital comparatively, and they have these large deposit liabilities. But their reputation is all important, and they have to manage their cash reserves. It's not regulation per se that determines the safety measures, the risk avoidance measures that a bank will take. They have to avoid danger just to stay in business. And they typically do. But sometimes things go wrong. And in those circumstances, again, with regard to the stability of the payment system, if a bank has misbehaved in the sense of abusing the trust and undertaking more risky lending than proves to be justified, and the shareholders deserve to lose all.
Yeah.
But there's a very strong case for protecting the depositors in those unusual but certainly possible circumstances.
So, Brian, on that point, because we saw earlier this year the collapse of SVB and two other important banks in the US, and similarly to the global financial crisis, at this point around shareholders of banks as not being absolved of responsibility in the event of banking failure. and the importance of making depositors whole because of moral hazard. Could you just explain why it's important for shareholders to bear the consequences of poor management in such situations, and how this principle encourages sound banking practices?
Now, SVB shareholders lost everything. The bank was worth nothing after depositors withdrew their money on a huge scale. And the bank itself was unable to convert the deposits that were being withdrawn into the deposits of other banks. The shareholders lose everything. And there's every incentive for shareholders of a bank to make sure that the bank stays in profitable business. There's always a danger in business generally that unwisely the shareholders of a bank indulge in more risky activities for the promise of high returns, which turns out badly. And that can happen with banks. So the allure of high returns encourages risk-taking. It's like private individuals, being enticed by high interest rate on their deposits. Moral hazard story applies to the depositors. Depositors should be very careful about who they trust their wealth to in the form of deposits. And if you insure deposits against loss and against the banking failure, then you're creating a moral hazard. In the case of SVB and in America, deposits were insured up to, I think it was 100,000 something. So it wasn't big enough. And it was the depositors who had more than the guaranteed amounts in these banks that suddenly took fright and didn't run. It wasn't a run on the banking system. It was a run on the individual bank. And that's in America, where you have 4,000 or so banks. That's a danger. It's not a danger in South Africa, where you have 5 or 6 banks that supply almost all of the deposits. Inconceivable that any one of the large banks in South Africa could fail its depositors. Though we now also have a form of deposit insurance. So you protect the depositors, you don't protect the shareholders. Shareholders go down, as they did in SVB. And that's right. That encourages them to be cautious and not to indulge in risky lending practice, which is mostly the case. And banks have every reason to want to stay in business. But let's add another point, which is, I think, crucial, is to understand banks are like other businesses. They are in a competitive business. They compete with other banks, both on the lending side of their business and on the borrowing side of their business. And competition, drives the process. The search for profits drives the demand for cash reserves. It encourages banks to use a proportion of cash to deposits they're holding, because cash doesn't earn that much, and also to usefully undertake lending activities. I remember again, the banks are not only important to the economy because they provide the payment system. They're also very important to the economy because they do lending. And where would our economy be without the supply of bank credit? How could businesses, prosper without bank credit? So this is very important in the understanding of banks. They are mobilizing savings. Banks are mobilizing savings in the form of deposits and putting them to useful use by funding businesses. And again, there's a concern. If all the banks are doing is funding the government and not funding business, you would have a much weaker economy, wouldn't you? Want the bank to be useful business, to help fund the inventories of businesses, to help capitalize in a way the businesses. Typically, banks also would be happier funding short-term working capital of banks, of businesses, rather than permanent capital. Short-term capital that rolls over. They fund their inventory. The inventory is then turned into cash, and the cash then repays the loan. That's typical bank business, safe bank, like for a farmer. You fund the farmer's seed. The seed turns into the harvest. The farmer pays you back for the short-term loan that the banks made, and it wouldn't work as well otherwise. So banks mobilize all this short-term savings, if you like, that come in the form of deposits. Every deposit is a saving, even if it's only a temporary saving. And the banks turn the pool of deposits into useful lending. And yeah, how important the regulation? Banks fail with regulation also. So there's nothing unregulated about the American banking system. What they couldn't regulate was the preference of depositors for safer banks over less safe ones.
When we talk about the regulatory efforts of banks, and I just think globally here, Basel and the various Basel Accords from 1 to 3 and the end game that we're heading through to now, the very heart of it is this effort to increase capital requirements that the banks must hold, as you mentioned earlier. Had it put to me that it may inadvertently raise the likelihood of individual bank failures, because as you increase that capital requirement, the chances of a bank approaching that regulated capital level increases just logically. And so therefore, the chance of a bank walking to the local regulator and saying, Mr. Regulator, we're close to our capital requirement level, whatever that level is, then gets into the marketplace, and you see a lack of confidence. And in today's world, digitally, you could have a digital bank run overnight. Do you think we've gone too far in our efforts to try and regulate banks and avoid bank failures?
I think almost certainly gone too far. We've created a whole industry, a whole legion of compliance officers for which the shareholders of banks have to pay. So all these requirements make banks, including the requirement to hold more capital, more than perhaps they would prefer to hold, makes banks less profitable. Now you say, all right, so what's wrong with that? You make banks less profitable. Well, like with any business, you make the business less profitable, you'll get less of it. So the trade-off here between regulation and the banking system is the role that the banks can play in your economy. I mean, if you force the banks to, let's say, take it to an extreme, let's say they've got to hold 50% of their assets in the form of capital and reserves, well, there wouldn't be any banks, and there wouldn't be any bank credit. There wouldn't be bank lending. So that's, I think, something that gets lost sight of. Banks are very useful. They provide the payment system, essential, but they also provide essential credit to growing businesses. And in a highly developed economy like the US, perhaps banks are proportionately GDP and the like less important, but they're very important in an economy like ours. So one should be sensitive. The bank should be saying, you're putting us out of business with this regulation. And that's not good for the economy. And I don't think it is good for the economy to simply emphasize safety. I mean, safety or reducing risk comes at a price. Reduce risk, reduce profits, reduce activity. So those are the trade-offs that no compliance officer is encouraged to think about. They think about safety first. Well, safety is important, but it's not always first. There's a trade-off between risk and return, and there's a trade-off between regulated capital and the role that the banking system can play. Yes, the global financial crisis was not helpful to that kind of argument. The banks clearly misbehaved. They took on more risk than they knew properly. They created that crisis around mortgage lending. But I think the Fed and the U.S. Treasury did the right thing. It saved the system. It didn't save shareholders. It saved the system. And I think that's what you've got to do. Punish the errant shareholders, protect the depositors who perhaps do not exercise nearly enough circumspection as to where they deposit their money.
And that comes back to that moral hazard story that you set out earlier, the fact that when we talk about the concept of moral hazard, it's about whether or not depositors are careful enough in their judgment when choosing where to place their funds. And I think a very important point raised that, because it's almost market mechanism to ensure some kind of market-based regulation over the banks, rather than this very forceful, prescribed, top-down Basel-type approach that we see. In South Africa, though, and if you'll allow me just to pivot quickly, when we talk about the South African banking system, and you mentioned how important the South African banking system is to developing an economy like South Africa, what do you make of exchange controls? And they clearly are still very anachronistic in the global financial world. The fact that we've still got these regulated controls of the freedom of movement of capital. Whenever I chat to high growth scale ups, they throw their hands up in the air and they say, how can we still have an environment where we've got to go and set up offshore structures in order to raise capital from foreign venture capital funds, for example, because of exchange controls in South Africa? And we've sometimes got to relocate our entire families. And over the long run, South Africa is losing that tax revenue, those skills. What do you make of exchange controls in 2023 in South Africa? Should we just do away with them?
Well, exchange controls are a constraint on freedom to do what you might wish to do with your own wealth. So it's not freedom, it's control. And South Africa long had a huge belief in controlling capital. Now that has fallen away. But just firstly, exchange control system is operated by the banks. It's not the Reserve Bank that runs exchange control. It delegates the responsibility to the banks. And the customers of banks have to satisfy the documentary and other requirements of their banks to process transactions that involve foreign exchange. And these days, the major impetus for these controls is to control money laundering. I mean, so much of what one even those letters that come from banks to say, if somebody's going to make you a payment, they want a letter from a bank to confirm that you have a legitimate banking account. That's your standard bank letter, which is out of date. But you need that letter, otherwise you won't be paid for the used car that you've sold to We Buy Cars. That's my experience. And then when you buy a car, which I've done recently, they take elaborate precautions to make sure that you are the identity that you proclaim to be. So they take a picture of you. Then they don't only look at your ID. They take a picture and they go through a whole robotic process. Even though you may be face to face with a salesman, that's not good enough. This is all the money laundering requirements, over which, incidentally, Bitcoin provides a major escape. I mean, where was hummus paid? Through Bitcoin. And so you got the money laundering. But for all practical purposes in South Africa today, practical purposes, not documentary purposes, but practical purposes, there is pretty much freedom from exchange control. If your tax affairs are in order, I think you can remit up to 10 million a year. And each tax-paying member of the family can do so. Those are effectively, and businesses can do business in Africa without any difficulty or encouraged to do capital transactions in Africa. So I think exchange control is not practiced in fact, though of course the documentary story is a complicated. Wealthy South Africans diversified their portfolios abroad through the allowance, through the asset swap system, and so forth. There's really no practical limit to the proportion of your wealth that you can have invested in foreign currencies or indeed in foreign banks or outside the country. So I think it's the money laundering story that's overtaken, and it's very expensive. All the hoops and you have to go through to make a transaction.
The cost of the grey list.
Yes, well, there you are. If we are not compliant with money laundering regulation, they'll take us out of the international banking system. which would be a terrible loss. Terrible loss.
So anyway, last question then, Brian, and I want to have you back on talking about exchange controls, because I've got a somewhat contrarian, maybe controversial view that I think the banks are actually lobbying for the continued imposition of exchange controls. I mean, it not only protects their deposit base to some extent, but it allows them, from an entrepreneurial perspective, to ask as many IP acquiring questions as they want to. Because if you're an entrepreneur and you want to transact with a foreign counterparty, you've got to go and ask permission from your local bank. But I don't want to digress from that. My last point is around this grey list. And there's been a lot of talk around getting us off the grey list. As I said in my introduction, we've now had this partnership with BASA, the Banking Association, with SABRIC, with the FSCA now to develop greater forensic capability. From where you're sitting, your vantage point, are we doing enough? Are we taking this urgently enough, this grey listing, to get off in the next couple of years?
No, I think we have to try and satisfy the international requirements of us, though we don't always govern very well, as you know. Think of visas. There was a time we could travel to the UK without a visa. Well, we lost that because we perverted our allocation of passports and so on. So, unfortunately, trading and traveling internationally demands that you meet certain legal and regulatory requirements. Whether they're appropriate or not is another issue. But you have to satisfy those requirements, and you have to have competent, if you like, government agencies that do the job. So clearly we lack competence, as well as malfeasance, I suppose, but competence to manage the system. Now, I work inside a bank, and I see compliance everywhere. Mm-hmm. And when you as I did with this motor car, you see an onerous system at work. You say, yeah, I'm sitting opposite a salesman. I've got to prove my identity. Anyway, that's so we've got to get us, if you like, our ducks in a row. We've got to offer competent enough government regulation so that we can do international business, so that we can travel, so that we can get a visa, and so on. That we can put money in a foreign banking account without too much difficulty.
I couldn't agree with you more on that last point, Brian, around creating so many compliance hoops to jump through in order to comply with issues in the formal sector, where I think the average bank, the average consumer, the average transactor has a huge bullseye on their back. That's not really where any of this takes place or goes on. And it's often been put to me that it's very much like a relay race, where it's the first runner with the baton, and that's the banking system, that really is pretty much compliant. It's the other three in the relay that comes more to the prosecutions and the FSCA and the FIC, where we do have those problems, and really where we need to see change.
There's a trust thing. We know that we are trustworthy. We're doing decent business, and we're complying. But we know that not everybody is doing so. So we're burdened with proving our trustworthiness, because in fact there are gaps and there are exploitable gaps in the system. So it's not our fault, but we got to live with the consequences of those.
Sadly, yeah, that is the problem. Well, that wraps up this fourth episode of the Monocle Banking Podcast. From regulation to SVB to moral hazard and the grey listing, as well as exchange controls, I'd like to extend my gratitude to Professor Brian Kantor, doyen in the field of finance in South Africa. Brian, thank you very much. And remember, you can find us on all good podcast platforms. Reach out to me at Badger on Twitter, or email the team at Monocle. Thanks for tuning in, and until next time, don't forget to subscribe to our channel. Take care.